Hello, and welcome to topic 8. So here we will be talking about receivables. Our learning objectives here are to look at the how to account for your recognition, measurement, and disposition of your accounts receivable, how to treat your bad debt under various methods, which is allowance, direct write-offs. We'll be discussing about those methods. We will be looking at the financial statement presentation of accounts receivable as well as notes receivable and how to look at accounting aspect of notes receivable. What will be the concepts related to concepts of future and present value of notes receivable and comparison between IFRS along with the financial statement representation of notes receivable. So getting started with the receivables here. In general, if you think of your receivable, these are the claims that the company has against their customers. Say, for example, if the company has provided services to the customer on credit, or if they have sold a product on credit, then we will see the accounts receivable. So that is a very common type of trade receivable that we do end up seeing, which is your accounts receivable. Other type of trade receivable that we generally see in the business world is the notes receivable, which is a written promise but has specified terms such as the length of the note, the interest rate, due dates, and the parties that are involved. Any investment in the government debt, corporate bonds, convertible debt, and commercial papers are not considered as are receivables because they are held for the purposes of trading. So we refer to them as held for trading investments, not so much as receivables. Depending on the length of your receivable, if it's under 12 months from your last financial statement date, then they are considered as current. Anything above that is considered as long-term or your non-current receivable. So your trade receivables are generally accounts receivable and notes receivable, which are as a result of your business operations. Other type of non-trade receivables that we generally see is advance to the employees, any receivables for the GST, for the income taxes that were overpaid to the government, any dividend or interest receivables, any amounts owing from the insurance companies. Outside of your trade and non-trade receivables, we also see some other receivables, which are loan receivable and notes receivable. Now, let's talk about the recognition of these receivables. So recognition is the process of bringing these receivables onto the books. So these receivables has to be recognized by the entity when they become a party to a contractual provision of the financial instrument. Okay, so what that means is when one of the party in the transaction has performed, they are able to go ahead and recognize that receivable. For example, if the company has offered the services or sold a product, then they have completed their part in the transaction. So they can go ahead and debit accounts receivable and credit sales. So the credit to sales is recorded along with your accounts receivable because the transaction has been completed. The revenue is earned now. When your credit sales has the extended payment terms, then we recognize that against the notes receivable. So when we are recognizing the receivables at the fair market value, they are subject to discount and interest elements. So because of that, we will have to adjust our receivable at amortized cost. So measuring these receivables have to show up on the fair market value on the statement of financial position. So if you're thinking of your trade discount, then your receivable has to be net of those amounts. We also have our sales discount. So here we have 2 by 10 net 30. How that is interpreted is 2% discount can be taken on these payments if the payment is made within 10 days, which is referred to as the discount period, 10 days from your invoice date. So if the company chooses to make a payment during that time frame, then they can take 2% as the discount, which means for a company that has receivable, their incoming cash will only be 98% if the payment comes within 10 days. Now, this is purely optional whether the companies want to take these discounts or not. They are not mandatory. If the company chooses not to take that discount and not to make a payment within 10 days in this case, then they have got net 30 days to make a payment. Now, any payment that is made from the 11th up until the 30th day is not going to have the discount of 2% here. Okay, we have our sales returns and price allowances, which are after the fact, and we also have time allowed to settle the accounts, which is generally ignored in this context. When you're thinking of adjusting your receivable to the amortized cost, we have to account for the interest component there. Now, just like any other asset, your receivables also have to be tested for impairment. Impairment really is the uncollectability. So if you are thinking of your accounts receivable, for example, one of your customers has filed for bankruptcy. So in that case, the money owed by that customer to the business becomes uncollectible or the receivable becomes impaired. Okay, so we have to account for that information that is also called as bad debt or uncollectible accounts. So as and when the companies know about that information, they need to go ahead and adjust their receivables accordingly. For your loans and receivables, if these are impaired, generally when we have a significant adverse changes, that will change the cash flow timing in the future. Under IFRS, we use the loss allowance that is based on the lifetime expected credit losses. Now, we want to make sure that there is a reasonable estimate made of the amount of accounts receivable that is unlikely to be collected in the future. Let's look at your accounts receivable. So accounts receivable is as a result of a business providing services or selling products on account. So under the normal course of business, these are referred to as your trade receivable. And the general payment terms here are net 30, net 60, depending on the business and the industry. So these receivables are recognized when the company completes their performance obligation, which is either selling the product or providing those services. Now, if you have any early payment discount that we were talking about, 2 by 10 net 30, we do not account for these discounts ahead of time because these discounts are optional. It is entirely up to the business whether they want to take these discounts or not. So that is why these early payment discounts, if they are offered and the company decides to take it, then we will go ahead and account for the discounts as and when that comes into play, not ahead of time. So we must monitor and write off if they appear to be uncollectible. So if there is any accounts receivable which seems to be uncollectible because a customer has filed for bankruptcy or for any other reason, then we have to make sure to adjust your receivable accordingly. And generally for doing that, we look at aging report analysis. When you're looking at your statement of financial position, your accounts receivable has to be indicated at net realizable value. So that is your accounts receivable minus any uncollectible amount that we are estimating. Now, how do we account for uncollectible accounts receivable? So the companies that does have accounts receivable look at their accounts receivable historical information to determine how can they estimate the uncollectible amounts. So there are two approaches that the companies can use. There is a first one is the direct write-off, or this is also called as no allowance approach. So here, the direct write-off approach is only allowed for businesses that generally do not have to write off any accounts receivable. Okay, if they have consistently been able to collect year after year, and once in a while they might have to write off an amount, in that case, the company can go ahead and use the direct write-off approach to account for the uncollectible. But for the businesses that have accounts receivable and consistently have bad debt, they have to follow an allowance method. And there are three ways that these allowance methods can be calculated. It's an allowance method, percent of receivable, and percent of sales. So let's look at these methods here. So allowance approach and your percent of receivable approach are very similar to each other. So under the allowance approach, the management is going to analyze the accounts receivable at the end of every month, and they will estimate the uncollectible accounts. your allowance for doubtful account, which is your contra account, is going to be adjusted to the correct balance. Okay, but you already, because allowance for doubtful account is a contra to accounts receivable, it's a permanent account. So if it would likely have a beginning balance, and if it does, make sure to account for that beginning balance. Here, the bad debt expense is adjusted against the allowance for doubtful account entry. Under the percent of receivable, we used a similar approach. So using the past experience, the management is going to estimate what percent of their accounts receivable is not going to be collected. That is called as an aging schedule. Once we have that, then we look at the accounts allowance for doubtful account. We will estimate the ending balance based on the uncollectible amount of accounts receivable. We will figure out the ending allowance for doubtful account balance. Okay, now because allowance for doubtful account is contra to accounts receivable, it's permanent, we have to account for the beginning balance in that account. And once again, the other side of that journal entry is going to be bad debt expense. But this approach, the percent of accounts receivable, does not focus on matching the bad debt to the sales. One of the simplest methods here is percent of sales approach. So here the company looks at their sales in a period, say for example, a month. They would have an estimated percent of uncollectible, let's say 3% of the sales are not collected. Okay, so the total amount of sales in that month multiplied with the uncollectible percent is your uncollectible amount. With all of these three methods, we have to recognize that the way the allowance for doubtful account is accounted for and the way it shows up on your statement of financial position is going to be a little bit different. So just make sure to pay attention to that. Moving on to our notes receivables here. So notes receivables conceptually work in a similar fashion as the accounts receivable, but these are slightly different in the sense that your notes receivable are a promissory note. These are going to have specific terms. So two parties come to an agreement, but with this agreement, there would always be two vital things indicated in the notes receivable. One is your interest element, the other one is your maturity date. Now, depending on the extent or the life of that note, it could either be treated as a short-term note or a long-term note. But the way it behaves is identical whether it's short-term or long-term. Now, because the notes always have an interest attached to that, we could see either of these two things. One is an interest-bearing note. Interest-bearing note is the one where the interest rate is explicitly stated on the note. We know what is the interest rate because it's there on the note. Alternatively, there is also an element called as a zero interest-bearing note. Now, the name is a little bit misleading, but this is non-interest-bearing note as the name suggests, but that does not mean there is no interest. It just means that the interest is not explicitly stated on the note. So we have to impute that interest rate. And the way to impute that is really, if you look at the interest, the total interest payment is the difference between the amount that is borrowed and the face amount. So if we account for that information, we can easily calculate the imputed effective interest rate. Your long-term notes and loans receivables have to be recognized at fair value, and that really is the present value of your future cash flows. So we will see two types of interest rates here. One is the face rate, also sometimes called as the coupon rate, which is the stated interest rate on your receivable, on your notes receivable. The other one is your effective interest rate, which is the market rate that is used for calculating the present value of future cash flows. This is called as the discounted rate. Now, if both of these interest rate, the face rate and the effective interest rate, coupon rate and the market rate, if both of those are the same, then effectively the fair value of your note and the face value of your note is going to be identical as well. If there is a difference in these rates, let's say if the market expectation is higher than the coupon rate, then the note is going to be trading at discount. Likewise, if the coupon rate is higher, but the market expectation is lower, then that note is going to be trading at a premium. Now, IFRS requires that the effective interest rate method is used. ASPE does not specify anything in particular in this context. Now, these notes can also be issued for property, goods, or services. So the issue here is to determine what that selling price would be. So if the market rate is known, then we will use that market rate to calculate the present value of future cash flows. But if that market rate is not known, which often can happen, especially if you're looking at businesses that has ASPE standards followed. So if the market interest rate is not known, then we will use the fair value of the property, goods, or the services to estimate the value. From there, we can impute or estimate the interest rate, and then we are required to record the effective interest income and amortize the discount. Talking about the derecognition of the receivables. So derecognition is really the process of taking these receivables off our books. Now, the easiest and the simplest way to derecognize a receivable is if the customer pays the company, we debit cash and credit accounts receivable, notes receivable, whatever the instrument is. So that is an honored note or accounts receivable. The transaction is completed, we were expecting to get cash and we have received it. Likewise, there can also be transfer of these receivables, and that can be through two items. One is your secured borrowing, where the company is using these receivables as a collateral to borrow from a financial institution. The other one is your sales of receivable, where the holder can transfer the ownership of the receivable in a sale. This is called as factoring, which necessarily means that the company that is selling these receivables is transferring the risk and rewards related to these receivables. So let's look at those two in detail here. So if you're looking at secured borrowing, the accounts receivable is still going to be there on the company's books. They are not going to derecognize the receivable. The receivables are going to be managed the same way. They are going to remind the customers, they will be collecting the receivable, recording the cash. If there is any bad debt, the company will account for that as well. So primarily, the company takes care of everything related to that accounts receivable, just the same way they did before using them as a collateral. Because they are used as a collateral, then the company also has to recognize a new liability, which is your notes payable. And because we have that liability, we will have to look at the interest expense on that note payable that needs to be recognized. On the other end, we have our sales of receivables. Now, with the factoring, the purchaser is buying the receivable for a fee, and then they will collect directly from the customer. Usually, this only involves one other company. Now, the purchaser is taking all of the risk as well as the rewards. And this is if the company is selling without a recourse. So seller in this case is not going to service the receivable. So they are going to derecognize that. What we got to keep in mind is only the buyer or the seller can have that receivable on their books. Both the parties cannot. Okay, so if the seller is giving it up, then the seller is derecognizing that receivable. Buyer is going to take it onto their books. They're going to recognize that. Because the buyer is recognizing it on their books, they will have to manage, collect, and take care of that entire process. Okay, so the seller is going to credit their accounts receivable for face value, and compared to the proceeds that they are getting for these receivable or the sales of the receivable, the difference is then their gain or loss on the sale of receivable. So with recourse, the purchaser is not does not have the risk of collections. That is not treated as a sale under IFRS 9. So how do we determine whether this is a sale or a secured borrowing? So here, this is the flowchart that we go through. So have the contractual rights to receive cash flow been transferred? If the answer is yes, then you are looking at a sale of receivable. If the answer to that is no, then we move on to the next question. Does the entity have an obligation to pay cash flows to recipients? If the answer is no, then we are looking at secured borrowing. But if the answer is yes, then we look at, does the entity have no obligation to pay amounts to the recipients unless collected from original receivable? Is the entity prohibited from selling or pledging the original receivable? Does the entity have an obligation to remit cash flows collected on behalf of the recipients without significant delays? If answer to any of those is yes, then we are necessarily looking at sales. Under ASPE standards, this is how we make the determination for the transfer of receivable. So the three questions that we ask, or the three conditions that needs to be met is, are the transferred assets isolated from the transferor? Transferee has the right to pledge or sell the asset. Transferor does not maintain control through repurchase agreement. If the answer to these conditions is no, then we are going to account for this as a secured borrowing, which means we will record the liability and the interest expense. The receivable will still be onto the books, no change on that side. If the answer to these conditions is yes, then the next question is there continuous involvement? If we say no, there is no continuous involvement, then that necessarily constitutes a sale. So we are going to reduce our accounts receivable, take them off our books, and recognize the gain or sale on that disposition. If there is continuous involvement, then we are going to record this as a sale, but we are going to use the financial component approach, which means we will be reducing the receivables. We will recognize the component of asset obtained and the liability incurred, and the difference would be our gain or loss. Looking at the disclosure requirements for receivables and the reporting. So under IFRS, we have to segregate the types of receivable from the current to non-current. If the receivable is over 1 year, then we need to report the amount and the maturity date. We also need extensive disclosure related to interest income, impairment losses, any reversal of these losses. What was the allowance method that was used? Okay, what is the securitization? What is the risk of exposure, credit risk, fair value information about the loans and receivable? So the disclosure requirement under IFRS for receivables is again quite extensive. And finally, looking at the comparison between IFRS and ASPE. So when it comes to cash and cash equivalent, IFRS allows the preferred shares acquired close to the maturity date, and ASPE does not allow equities to be considered cash. Recognition and measurement of receivable, IFRS requires the use of effective interest rate method, and interest income and amortization has to be done. Under ASPE, we can use either the effective interest rate method or a straight line amortization method for accounting for the interest component. Related to your derecognition, under IFRS, we will consider whether the substantial risk and rewards of ownership has been transferred. Under ASPE, we consider who has the control of the asset. And under IFRS, the disclosure requirement requires detailed quantitative and qualitative disclosure. Under ASPE, we just do the basic disclosure. That is topic number 8. Thank you.